municipal bonds from Henyon & Walsh. If you have at least $10,000 to invest, call and talk with one of our bond specialists at 1-800-279-5279. We'll send you our exclusive bond guide, free, with details about how bonds can be an important part of your portfolio. Henyon & Walsh has specialized in fixed income and growth solutions for 30 years and offers high-quality municipal bonds from across the country. They provide the potential for regular income, are federally tax-free, and have historically low risk. Call today to request your free bond guide. 1-800-279-5279. That's 1-800-279-5279.
23 seconds away from the opening bell in New York City this morning. Good morning to you all. Your equity market is higher by 20 points. Very used to staying lower at the moment. Forgive me, up 20 points on the S&P 500. Futures advancing 0.9% on the Nasdaq 100, up 137 there. That's the opening bell. Switch up the board and get to the bond market. Your 10-year yield looks a little something like this. Yields in 4 basis points on 10s to 182.72. Let's call it 182.90 off the back of a upside surprise on jobless claims. The wrong kind of upside surprise when claims move in that direction. Euro dollar 113.43 unchanged there. Crude comes in about 0.1%. 86.84 on WTI. About 20 seconds into this one, the S&P 500 does advance by about 0.1%. No drama here. Information technology up 0.9%. The S&P now has a list of 0.4%. Energy is where the monster outperformance year to date has been in the equity market. That lags. That's down by 0.7%. Looking ahead to next week, all about the Fed. We caught up with Mohamed El-Erian a little bit earlier. He had a suggestion on how the Fed could regain its credibility.
They've got to immediately stop QE. They've got to stop QE at that meeting. They've got to announce that come March, we're going to have the plan for QT, and they've got to socialize quickly the expectations of at least 2 to 3 hikes. And John, really important, explain to us why you got the inflation call so wrong and why you stuck with transitory when a lot of people had moved on.
That's what he'd like to hear, not necessarily what we will hear next week. Back with us, Emily Hill, Jim Karen, Stuart Kaiser. Jim Karen, I want to come to you first on this one, buddy. Let's talk about it. The prospect of the NQE just a little bit earlier.
Look, I think it's a possibility. Typically, they foreshadow these things well in advance. So I don't think it's going to happen on, at the January 26th meeting. But I do think that at March could be a very live meeting in terms of laying out a plan or a framework to start quantitative tightening, which means selling assets, not just letting things run off their balance sheet. I think they do need to be a bit more aggressive. But John, look, I think one of the big questions that we have to understand is that inflation, we believe, is going to come down in 2022, but will it come down enough to a level that makes the Fed satisfied that they can claim victory? I think it's out of the question that we're going to get something like 2 or 2.5% core PCE by the end of this year. At least that's my view. I think that inflation is going to be higher than that. So what is the inflation target then between now and the end of the year for the Fed, and what would they deem acceptable? Because the risk here is that if inflation doesn't come down enough, that the Fed becomes much more aggressive, and then that sends a recession signal for the years out in 2023, 2024, if they start to move too quickly and tighten financial conditions too much. So I think the next meeting is very important on Jan 26 about messaging what they're going to do, and in March, it's go time.
Jim, let's talk about what we're doing ahead of go time. Last year, a lot of people in fixed income were scrambling for inflation protection. This year, the scramble is all about interest rate exposure. Loans. You've seen loads of what they've been doing recently, Jim. How expensive is that story now?
Well, look, I mean, everybody's been expecting rates to move higher. So, owning things like bank loans have certainly been a good place to be to the extent that you can float with higher rates. The other thing that it does is that it reduces the interest rate sensitivity of your portfolio. So essentially where we want to be today within fixed income is we want to have like a barbell strategy. We want to have good quality assets, but at the same time, we want to reduce the interest rate sensitivity. So that means of the portfolio. So that means getting into shorter duration assets, but also also getting into assets with more credit characteristics that aren't exposed to higher interest rates or don't necessarily have a negative return if rates go up because they're just less rate sensitive. So really, I think putting these things together and creating a balanced portfolio between something like, say, bank loans on one side and then some shorter duration, high quality credit on the other, and then being short some, treasury duration, for example, to play for this move in higher rates, seems like the right type of portfolio at this point.
Emily Hill, can you take that a few steps further? Your thoughts on the same issue?
We do like bank loans. A lot of money is poured into them for the reasons that were just stated. I actually think that one of the things that is being missed here is some headwinds that are going to, we're already seeing economists readjust their GDP forecasts. And when you look at this particular variant, the Omicron variant, is arguably the fastest spreading virus in history, even more so than measles, for example. So when you look, we already have a restricted labor supply. And when you look at the number of people, let's just say 20 million people get this virus in January and February, and 60% of those people are working. That's a lot of lost work days. So I do think that I agree that inflation will likely moderate, probably not as much as people want it to. But when you look at the jobs numbers and you look at the slight decline in the manufacturing index, it may be that the Fed doesn't have to move as aggressively as the consensus is starting to believe. You're hearing a lot of 50 basis point hike in March, maybe 4 hikes in 2022. That's not a foregone conclusion.
I hear the same thing from Steve Englander at Standard Chartered. He thinks the inflation story peaks at the end of this quarter. He thinks we only get 2 hikes through 2022. There's a range of views here. Your equity market about 5-6 minutes in is higher, up more than 1% on the Nasdaq, up about 0.5% on the S&P. Some earnings to talk about. A lot of airlines in the mix. Netflix a little bit later with more. Here's Abby.
Hey, John. Well, of course, this year is all about the great rotation into value, and to some degree, we are seeing it this morning with American Airlines popping. They put up an inline quarter. The fourth quarter, their revenues doubled from a year ago, so the pandemic lows behind them. And encouragingly, CEO Doug Parker says that consumers are ready to get back on planes. They're confident, so their bookings 1 to 2 months out are very strong. Netflix, on the other hand, less so. This stock absolutely pummeled from its November highs, down more than 25%. And of course, this stock has everything to do with subscriber growth. 3 months ago, Wall Street expecting 8 million subscribers added in the fourth quarter. Now, though, really a lot of analysts tailing that in. JP Morgan, for example, at 6.25 million. Perhaps that is what this stock reflects. Also, tech in general for the fourth quarter, earnings growth expected to be coming in a big way, up about 14% relative to the fourth quarter at 40%. So that could have something to do with the correction in the Nasdaq, what we've been seeing. The question is, will these earnings, Netflix in particular tonight kicking it off, perpetuate it? We'll find out, but not surprisingly, with Netflix down in such a big way. This year is all about the reopening trade. The reopening trade is up just modestly on the year, whereas we have that stay-at-home trade down in a big way on the year so far as big tech drags, John.
Abby, thank you. Stuart Kaiser, Bank of America. Savita Subramanian has come on with us recently, and she said something's got to give. We think it's going to be margins. Do you agree?
I think it depends over what time frame you're talking about. I wouldn't expect margins to give it up this quarter. Our view is you're going to have about a 10% beat of consensus EPS in 4Q21. But clearly the margin debate is the one that's going to frame corporate outlooks, and I think probably frame the consensus outlook. So if you're looking for what is going to drive equity markets coming out of earnings, I think it's probably the view on margins and probably what the view on earnings growth is going to be. As I mentioned earlier, you're going to have decelerating growth in your forecast once you get past this earnings season. To Emily's point, we've seen claims, industrial production, Empire State Manufacturing show a little bit of weakness too, at a time when inflation is still peaking. It's easy for me to say, hey, inflation is going to peak at the end of Q1. You don't need to worry about it. But it's going to be the end of 2Q probably before we're really, confident that that's happened. So all of that is going to play into the margin story, and I would agree that that's kind of a line of demarcation as we move forward.
Emily, talk to me about margin erosion, where you'd expect it to be concentrated the most, sector to sector through the U.S. equity market.
I'm not sure I quite understand your question. You're just a comment on margin expansion.
Sure. Let me build on it for you if you didn't quite hear it, Emily. When you think about margin erosion, if margins are going to get hit, do you think it's concentrated in various sectors as opposed to others as you look across the U.S. equity market?
Oh, absolutely. I think there are actually parts of the, value stocks, for example, where we may continue to see margin expansion. On the growth side, yes, I think that margins have expanded so much in the last year and a half, 2 years, that reversion to the mean is just to be expected. And so I think that is actually the double whammy that's hitting some of these tech stocks and U.S. growth stocks generally. If you look at the NASDAQ, over 40% of the NASDAQ has corrected 50% or more. So part of the NASDAQ's actually in a bear market. And I think when we get through earnings, then there's not as much upside for margins.
There's a part of this market which is absolutely flying, though, with the exception of today, and it's the energy stocks on the S&P 500. That sector is up by 15% and some. Crude today is a little bit lighter, softer, lower, down 0.5% to 88 on Brent and 86.70 on WTI. Jim Kern, can I finish there? Just how important the energy story is in all these conversations we're having.
I think that's the crux of a lot of the inflation surprise. So one of the things that we look at here is that we're talking about the Fed, we're talking about tightening financial conditions, but it's all really hinging on people's inflation expectations if inflation rolls over or not. And what we're seeing is that the energy sector is giving us no help in that argument whatsoever. That if energy continues to move higher, not just in the U.S. but also in Europe, so we can think about global inflation pressures as well, that this is a story that has legs. And when we think about the disinflationary factors that may come into the market over the next several months from goods prices falling, what we have to remember is that there are sectors of the market like energy and owner's equivalent rent and things like that that are going to be pushing inflation a little bit higher. So it's a real tug of war between these two sectors. We have to get the energy sector under control in terms of pricing. I don't know how that's going to happen, and I think that's going to be one of the upside surprises to inflation, or at least keeps inflation from falling as much as people hope and think.
Jim Kern, thank you, sir. With Emily Hill, Stuart Kaiser. Guys, thank you very much for working through the opening band. About 11 minutes in, we do bounce back. Just got a note from Bank of America. They just published on the US dollar. They see the dollar gaining on a fight with US inflation. Euro dollar right now in and around 113, 114 in the past week. They see euro dollar at 110, dollar yen at 118 from 114 from where it is at the moment. A call from Bank of America there for you. Coming up, President Biden pledging to keep pressing for lower crude prices.
We're going to continue to work on trying to increase oil supplies that are available, but it's going to be hard. That brought down the price about 12, 15 cents a gallon, some places more. There's going to be a reckoning along the line here as to whether or not we're going to continue to see oil prices continue to go up.
More on that next.
This is Bloomberg's The Open. I'm Kriti Gupta. You're looking at a live shot of the principal room. Coming up, Brian Moynihan, Bank of America Chairman and CEO. That conversation at 10 a.m. Eastern, 3 p.m. in London. This is Bloomberg.
My trade rep is working on that right now. The answer is uncertain. It's uncertain. I'd like to be able to be in a position where I could say they're meeting the commitments, more of their commitments, and be able to lift some of it. But we're not there yet.
From China to Russia, the administration grappling with geopolitical tensions. President Biden warning of the consequences of a Ukraine invasion.
But if they actually do what they're capable of doing with the force amassed on the border, it is going to be a disaster for Russia if they further invade Ukraine, and that our allies and partners are ready to impose severe cost and significant harm on Russia and the Russian economy.
Joining us now is Bloomberg's Anne-Marie down in Washington, D.C. Anne-Marie, if I speak for 10 minutes, I'm going to make a mistake. 2 minutes, I'll make a mistake. The president spoke for almost 2 hours, and for a lot of people, he made a mistake, and this was the quote. It's one thing if it's a minor incursion and we end up having to fight about what to do and not to do. We've had some additional clarification from the administration on what he meant by that. We've also, in the last few minutes, heard from the Ukrainian leader. Can you run me through both those things?
So the president did say, when he was talking about sanctions, that there could potentially be a fight within the Western allies if it was a minor incursion. Now, remember, Jonathan, this is Europe's backyard. They do not want to inflict pain on President Vladimir Putin that could potentially reverberate into their own economies, especially also when it comes to natural gas. Energy is really a big part of this because more than 40% of natural gas from Russia goes into Europe. So that's one area where the president shed some light of the tensions with the West. Then they've come back and they've really tried to just clean up the language and saying any invasion, a military invasion, crossing that line would mean repercussions and sanctions on Russia. The question, Jonathan, if you're sitting in the Kremlin this morning, is potentially what Putin could be weighing is what can he do in terms of a land grab to keep Ukraine part of his orbit and sphere of influence and at the same time divide further the West in terms of how they're going to respond. And in that moment, potentially Biden gave a little bit of an advantage to President Vladimir Putin.
Anne-Marie, a difficult moment for the administration and for many politicians worldwide at the moment, and of course for the Ukrainians. Anne-Marie, thank you very much. That additional clarification came from the spokesperson for the NSC for this White House. Emily Horn said the following. He was referring to the difference between military and non-military paramilitary cyber action by the Russians. She went on to say such actions would be met by a reciprocal response in coordination with allies and partners. The cleanup effort continues. The White House on the energy push is now running out of options, and clearly for some people there is a conflict here between the objectives to get crude prices lower and the foreign policy goals too. We caught up with Brian Deese. He says it's a problem.
Some of the tightness in oil markets right now is a function of the fact that those supply targets have not been hit because there's been events in certain countries. We can work and engage with those countries. This is work not yet finished. And the American people are frustrated, understandably so.
Bloomberg's Julian Lee joins us now. Julian, clearly Brian Deese thinks the crude price is a problem. The foreign policy objectives, whether they are in conflict with what they want to do with crude prices, remains an open question, Julian, but I think the answer is somewhat obvious. Can you run me through what this administration can do? The president said yesterday in that news conference that they can do more to get crude supplies up. You saw what we did last time around, and we both saw what they did last time around. It hardly had any impact whatsoever, Julian. What can they do?
Well, I think they are in a real bind. I mean, you know, there's 2 or 3 things they can do. They can continue to put pressure on the OPEC Plus producers to open the taps more quickly than they are doing already. They can urge US oil producers and perhaps put in place some kind of incentive, although what that might look like, I don't know, to stimulate drilling in Texas and in the Permian Basin and other shale basins in the US. Or they can release more oil out of the strategic reserve. None of those really is looking like a good option. Part of the problem with boosting OPEC Plus supply is that every time you increase supply, you reduce their spare capacity, their ability to deal with any sudden loss of supply, through geopolitical or weather-related incidents anywhere in the world. That's already looking like it's going to get to very low levels by the middle of this year. Stimulating domestic production, in one sense that's the obvious way to go, but that runs very much contrary to the bigger environmental program of this administration. And releasing oil from strategic stockpiles, well, we've been there, we've tried that.
Yeah.
The take-up has been, it's not quite been minimal, but the exchanges that they put in place have only, so far at least, taken around, I think, around a quarter of what was on offer. And the sales are really not picking up that fast either.
Julian, yesterday the president also said that maybe they can look into alleviating some of the dependence of the Europeans on Russian gas. As you know, Europe gets more than 40% of natural gas from Russia. Julian, how are they going to do that?
Well, again, this is a big problem. Can you put much more on liquefied natural gas tankers to carry it over to Europe? I would imagine that most of those facilities in the current export environment are operating at close to capacity. The rest of Europe's supplies come via pipeline. You can't move where a pipeline is. The pipeline links Russian gas fields to European customers, and it's going to continue to do so. Yes, we've got pipelines from the North Sea, from North Africa, from Central Asia, but those are either full or the ability to produce more gas to put in them is severely limited too.
Julian Lee of Bloomberg on the energy story right now. Julian, thank you for that, buddy. Appreciate it as always. Crude on WTI just short of 87, now unchanged on the day. Brent 88. I mentioned we heard from the Ukrainian president out on Twitter saying the following: we want to remind the great powers that there are no minor incursions and small nations, just as there are no minor casualties and little grief from the loss of loved ones. I say this as the president of a great power. The words of the Ukrainian leader in the last 30 minutes or so. Let's get you some sector price action. This equity market bouncing back. Here's Kriti Gupta.
Yeah, good morning, John. You are seeing a little bit of defensive trading, green on screen when it comes to the S&P 500. Let's just start off with the laggers because it really comes to your point on those energy prices. You are seeing a marginal dip in oil prices and, of course, energy and materials following that lead. To the top of your leaderboard, though, like I said, a defensive tilt. You have big tech really leading the way higher, communications, consumer discretionary, of course, those yielding sectors as well, utilities and real estate also higher on the day. I want to really point to this tech trade that isn't just here in the United States, but it is global this morning. A lot of that concentrated in those Chinese ADRs, essentially investors betting that that easier Chinese monetary policy, will actually increase some of the attraction into some of those Chinese ADRs that we know have been under quite a bit of regulatory scrutiny, John, and taken quite a bit of a hit in 2021.
Kriti, thank you. Coming up, your trading diary as we work our way towards the weekend and into next week for that Fed decision. From New York, this is Bloomberg.
bloomberg.com/hire.
The big winner of the year, energy equities, at the lows of the session. They're the losers of today. The big winners of the year, energy, at the lows of today. The big losers of the year, information technology, they're leading the way higher today. The S&P up 0.9%, the Nasdaq up by 1.4%. In the bond market, you've got a decision to make. What we saw in jobless claims a little bit earlier this morning, is that just some temporary weakness associated with COVID, with Omicron, or is that the beginning of maybe a slowdown that the Fed might hike into? They're your two options at the moment. I can find you a group of people who think one thing and a group that thinks another. That's the market. Yields higher through much of the year, lower this morning by 3 basis points to 183. Let's get the trading diary. What you need to be looking for, existing home sales at the top of the hour. The EIA publishing its weekly crude oil inventory a little bit later. Netflix earnings after the close. Then looking ahead to next week, we get US market PMIs on Monday. And finally, the main event on Wednesday, a Fed rate decision and Chairman Powell news conference. From New York City, this was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.
Earnings season is here.
I'm looking at ratios that are jaw-dropping.
Investor expectations are low.
This is an opportunistic stock picker's market.
It's going to be volatile. Bloomberg breaks the numbers first.
Wells Fargo breaking the rules.
Citigroup on top.
Those numbers are just massive.
An expert analysis you won't get anywhere else.
I'm going right to return on tangible equity.
They missed on FIC trading. They missed on equity trading.
They're too hot.
Empirically, we don't find that to be the case at all.
Bloomberg Television and Radio. The fastest numbers and analysis you trust. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, January 20th. Here are the top market stories that we are following for you at this hour. Tumultuous tech now turns to Netflix. The streaming giant kicks off big tech earnings after the closing bell. Can Netflix turn around that tech sentiment? And Biden's Russian misstep. President Biden says Russia could opt for a smaller scale incursion into Ukraine, making cohesive Western response harder. We're going to speak to Ian Bremmer, Eurasia Group president. And get back to your desks, everybody. Goldman City asking London staff to return to the office. We speak to the head of another big bank, Brian Moynihan, Bank of America chairman and CEO. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets, Guy. It's good to see you. I missed a doozy of 4 days of heavy news flow.
Yeah, I mean, just get the data out of the way, and then I want to talk about what exactly you missed. Housing data just hitting the tape at the moment. 6.18 million is the year-on-year number. That's certainly off the pace. 6.42 is what we were expecting. Maybe signs certainly that A, high prices, a lack of supply, and mortgage rates rising starting to have an impact. That's just something that we want to be folding in terms of the numbers that we're watching. But let's get back to the fact that Alex had 4 days out, and the world changed, I think, in those 4 days, Alex. So what do we have? We had I'm not blaming you. I'm just saying it happened.
He is.
You had the NASDAQ correction, so we had a 10% down from the highs. You've got the market now pricing more than 25 basis points at the March meeting, so people are now talking about 50. You've got potentially an end to the bull market broadly. You take a look at what the technicians are saying. Alex, they're getting super excited. I could go on and on and on, but we've run out of time. But basically, please don't take any more time off because it was a little bit hectic, to be honest.
No, I know. When I saw the news flow, I was like, oh, man, Guy's going to be mad at me. There's a bitter work husband there coming at me.
Oh, yeah. And I didn't even mention the fact that the commodities market was absolutely on fire and oil prices were surging higher. That I know you would have been excited about, but I know you were excited about all of it. But yeah, please don't take any more time off. I'm not sure I can do another 4 days like we've just seen. Friday cannot come fast enough. Sarah Hunt joins us now to join in the fray. Sarah Hunt, Alpine Woods portfolio manager. Sarah, Alex has had 4 days off. The world has changed, I think, in those 4 days. We certainly seem to now be pricing in a much more aggressive Fed. Tech has taken a tumble. How do you see the world right now?
Well, no harm to Alex, but I think it was more than just the last 4 days. I think it was sort of people woke up at the beginning of 2022 and thought, oh my goodness, the world has actually changed. The Fed is going to not be at our backs. It's going to be, the wind is going to be coming at us on that front. And I think that all of a sudden, all of the things that we were surprised that nothing happened in the back of 2021, when it started to become clear that the Fed was changing its ideas about what they needed to do, didn't seem to rile equity markets at all, and now it seems as if everybody woke up and thought, oh my goodness, we're going to have to do something about this, and this is going to change valuations, it's going to change multiples, and it's just going to change the way we look at equity investing over the next 12 months.
Okay, so what do you do? I mean, that was my question over the last few days. Like, as an investor, and you're looking at this price action, the volatility, what do you do?
Well, to some degree, you know, people already had started changing some of their positioning, at least we had last year, and we were never really all in on some of the very high valuation tech stocks to begin with. I mean, we own some technology, but I think there's going to be a bifurcation between those profitable companies that are huge cash generators and those that are struggling to generate any kind of cash. And I think in that environment, a higher rate backdrop is not particularly good for the ones who can't generate a lot of cash. I think that's going to be true across the board. I think valuations are finally, after quite a long period of time, going to start to matter. And cash generation and balance sheets are going to be very important as we navigate what is no longer a very easy Fed policy going forward.
Sarah, there's been this narrative over the last few days, while Alex has been out, I'd like to point that out just again, that we shift to value, that value is going to outperform. My question to you is, are some of these companies with strong free cash flow that look relatively well valued compared with some of the names that you've just been talking about, some of these tech names, are they going to outperform in absolute terms, or are they going to outperform in relative terms?
Well, I think it's more about valuation versus value versus growth, because I think that there has been an enormous amount of stretched valuations. We've been talking about it collectively for the last couple of years. And it's only when you start to see a change in the backdrop that that starts to matter. So I think that companies with reasonable valuations are going to be able to perform fairly well, but they're going to have to get that growth. It's going to have to be profitable. Margins are a huge question this year, and you're going to start to see where that differentiates. I mean, you've already seen a huge move in consumer staples because those companies finally have some pricing power. We were talking about pricing power last year. I think there are tech companies that have some pricing power, so I don't think it's a pure rotation out of tech and into pure value, but I do think that it's going to matter how people start to see earnings and how companies start to talk about earnings and whether or not, as you've seen with some of the banks, the compensation becomes a bigger issue because that's a much longer tail on inflation than simply supply chain bottlenecks, which is what I think everybody was hoping that inflation was about. But you've got a couple of different issues on the inflation side. You've also got energy prices, and I know that's near and dear to Alex's heart, but there's very much an issue going on right now with energy, and not having cheap energy complicates the inflation picture dramatically.
So then to that point, I mean, I feel like we're talking around tech at this point. We've seen a big re-rating, and I wonder if the earnings that we're going to get from some of the big tech companies like a Netflix today is going to justify the current valuation. Like, have we re-rated enough here?
Well, I think Netflix is a difficult one to start with because they've always had a pretty high valuation relative to the cash they were able to generate. They finally got to the point where they were able to do some, but they spend a lot of money on content, and that has not changed during the pandemic. So I'm not sure that they're the best bellwether for whether or not earnings are going, tech can turn it around, as it sort of said before the break. But I do think that you're going to have to see some growth in some of this tech, and if you don't see it, the fact that earnings are coming through is not going to be enough.
Just in terms of the baby in the bathwater in all of this, and Netflix trades at 39 times forward, which is still fairly punchy, even relative to where it was before. Do we see the baby being thrown out with the bathwater? What I'm wondering here, Sarah, is does even the good stuff go down in this kind of environment? It may outperform, but does everything go down?
Well, I think that the knee-jerk reaction at the beginning is to sell everything and to swap out of tech and into other things. The question is, what part of tech is then going to come back as people start to say, okay, those earnings are not so bad and we still need growth. And that's part of the problem with value, is that sometimes there isn't a lot of growth there with value as a whole as opposed to growth. So I think that there will be a knee-jerk reaction. I think you've already seen it. I mean, the top big mega caps have not been hurt as much as the underlying stocks in some of these indices. But I think that there are places where, I mean, we like a stock called Akamai. They do internet routing traffic, but they also have a security business that's growing. That's not at a crazy valuation, and I think that the security business is going to continue to grow. Does it matter in the knee-jerk first reaction when people just sell tech? Probably not. But you're going to see people come back to those stocks that can prove that they can generate cash and that there are valuations that are still believable in that they can grow even further. So I think that that's really, you're going to see some differentiation there.
For the stuff that's still in the bath, you mentioned it earlier, like energy, for example, up 16% so far year to date. Where would you be buying in the energy world when you're still looking at WTI at 80, you're looking at some super heavy call options in the triple digits? Where still has the value?
Well, there are some industrials that play into the energy sector. A company that we like is called Flowserve. They make a lot of the big valves that go into pipelines for both petrochem and for oil and gas, as well as other things that need big pipelines. I think there are some places where you can find that supply into the sector. Unfortunately, the desire to have cleaner energy has meant that there has been a sort of demonization of, hydrocarbons in a way that complicates the picture right now, because it's much more about politics than it is about the normal cyclicality of oil and gas. And right now that politics is sort of showing you that you're getting less supply at a time when demand is finally coming back and coming back pretty strong.
Hey, Sarah, it's always good to see you. Thank you so much for joining. Couldn't ask for a better guest on my day back. Yes, that's right. I was out for 4 days. Sarah Hunt of Alpine Woods, thank you very much. Coming up, Bank of America's latest results getting a good boost from clients who are taking on debt once again. We're going to have more with Brian Moynihan, Bank of America Chairman and CEO, coming up next. This is Bloomberg.
Earnings season is here.
I'm looking at ratios that are jaw-dropping.
Bloomberg is fastest with the numbers and analysis.
I'm going right to return on tangible equity.
They missed on FICC trading.
They're too hot. Bloomberg, the fastest numbers and analysis you trust.
Live from New York, I'm Alex Steele. Guy Johnson over in London. This is Bloomberg Markets. Bank of America stock is up about 0.5% over the last 2 days after bank earnings came out. You're going to benefit from a growing economy as well as those rising rates. What is in the future for the company? I want to send it right over now to Bloomberg's David Weston.
For our Bloomberg television and radio audiences worldwide, I'm David Weston, and we're delighted to welcome now the chairman and CEO of Bank of America. He is Mr. Brian Moynihan. Brian, thank you so much for being with us. You announced earnings this week, and one of the things everybody was interested in was loan growth. Give us your sense about where you are in loan growth, but maybe as important, where you see loan growth going.
Well, David, it's nice to see you again. And, so we announced our earnings, $32 billion in record earnings in 2021 for the company. The team did a great job delivering for their clients and shareholders and communities and each other last year, so I want to thank them publicly. But in terms of loan growth, we had $50 billion of loan growth in the quarter, not in the year, in the quarter. About $15 billion of that or so was in the markets business, which can ebb and flow, depend on securitizations and things like that. But 35 was core in the wealth management business and the commercial banking business and consumer businesses. And so that we see, what we told people yesterday is you should expect us to grow faster in the economy at probably, upper single digits this year. And what's good about that is two things. One is there's tremendous capacity to borrow still in our customers, whether it's credit cards still $20 billion off the peak, or whether it's line usage by our commercial clients that was at 35, went to 25, now back up to 30, round numbers to give you a sense. So that means clients have an ability to borrow to keep the economy going. And then secondly, for the good of Bank of America shareholders, loan growth actually is a way we extract the value of this huge deposit franchise, and that's good for their earnings.
So, Brian, I've talked to some people in the industry, maybe not who run banks, but some people in the industry who say they think the opportunity in future loan growth may well be in the middle market, sort of the smaller and mid-sized businesses. The big companies have borrowed what they need to borrow, and consumers right now don't need it. Does that sound right to you?
Well, David, our global commercial banking business run by Wendy Stewart, and then we have two businesses which go to, quote, the middle market. A fellow named Raul Anaya runs business banking, which is up to $50 million in revenue, and Wendy runs up to $2.5 billion. Those businesses, Wendy's team, I think, had 8% loan growth for the quarter. Those are major corporate, middle market America. And so there's two aspects to it. We're seeing more demand for loans there. We're doing more with more clients. We're actually deployed hundreds of relationship managers over the last few years investing in the future, and they're now having success. But importantly, the second part of that is as people use those lines, that means economic activities going forward. So they are the window into America's sort of economic soul in the terms of mid-sized companies and small businesses. By the way, in the all-important small business segment, which Sharon Miller runs for us, we actually have seen 125, 150% of monthly production, quarterly production compared to where it was before the pandemic. So not only have we gotten it all the way back, we're actually growing and creating more loans per quarter, which again is good for the economy, and that shows you the economic activity continues to pick up.
Brian, one of the drivers for your earnings that you announced this week actually were investment banking fees, up something like 26%. Investment banking mergers and acquisitions has been very, very hot in recent months. Do you see it continuing in 2022, or do you see it trailing off?
Well, Matthew Coder, who runs our large corporate investment banking business for us, not only in loans and cash management fees and everything, had a great year in investment banking, all 4 quarters above $2 billion, record numbers for us. The pipeline is still full, and some of that was always is always market dependent. There was deals, equity offerings and stuff, whether they get pulled or not if the market's bouncing around. But the pipeline is more than full, and they had a great quarter, a great year, and the team has continued to drive good market share gains year over year, and we couldn't be prouder of them. But the reality is that revenue can come and go, based on market activity. The good news is we get a lot from financing activity, which tends to be steadier, but the advisory business, which is strong right now, will really be dependent upon companies making decisions to buy and sell and things like that, which right now is full in the pipeline, and hopefully it continues.
Brian, you know better than anyone, it's not just the top line, it's also the bottom line. You got a lot of credit for controlling expenses in the earnings that you announced. On the other hand, there's a lot of competition for talent when it comes to banking right now. You said that we will step up to the plate. You won't lose people you need to lose. Can you manage expenses effectively and still pay the top dollar that's really coming in for bankers now?
Yeah, I think if you think about the broad expense base, the team's done a great job over the last 12 years. They've been together doing it, to bring the expenses in the company down in line, get the efficiency down. And then, then frankly, the expenses rose during COVID, for a whole host of reasons, including the success of the more markets-related business revenue, whether it's the financial advisors in Merrill Lynch, the private bankers, and then the investment bankers and the traders under Jimmy DeMar's leadership. So yes, those compensation levels have risen. But importantly, David, remember, we've also in the last 2 years gone from 20 to first of all, accelerate our move to $20 an hour to start our wages to 21. We've increased the compensation of the company dramatically across the years. But how do you make that all work? Well, you keep engineering the company, keep working on processes to take out cost and reinvest it in the people you have left. So our headcount last year went down by about 2%, and that was just through the operational excellence we have, and we continue to do it. So we have a company that's a lot bigger now. When I became CEO, we had 300,000 people at the peak in my first year of being CEO. We now have 208,000 people. The company's bigger, has more activity, and that's just by the operational excellence, which everybody in the company drives. 2,000 ideas last year alone to make our company incrementally more efficient. So you take that money and you invest it back in clients, capabilities, and technology, and people, and pay, and that's how we maintain our competitiveness.
For our Bloomberg Television and radio audiences worldwide, we're talking with Brian Moynihan. He, of course, is Chairman and CEO of Bank of America. And we're talking about banker compensation right now, and that goes really to the heart of what I was going to ask, Brian. One of the problems with wages is it's hard to cut them. It's easy to raise them. It's hard to cut them. It's not like prices for other things. How much of the compensation increase is baked into the structure for Bank of America, and how much of it, frankly, varies with what the income is?
Well, it's a tale of many cities in the sense that there are some businesses which have not as much leverage in them as they call it, so therefore their compensation structure maintains constancy. There's bonuses. Overall, we have about $32, $33 billion in compensation and related expenses, benefits, compensation, bonuses, et cetera, for our team of our $59 billion in expenses. So it is the biggest expense by a lot. And so the only way to really to manage that is actually how many people you have going through it. You have to be competitive. You have to pay people. We don't want people who want to work for less next year. Now, if the equity markets drop, that changes the way the grid works and the financial advisory and the revenue comes down and the pay may go down. That is not something we ever hope happens. We'd rather pay people more and grow the business. So, there are parts that move that way. There are parts that don't move that way as much. But the reality is it's a multifaceted, complex discussion. But our job is to be fair, be a great place to work for all our teammates, and that's what we do with our compensation practices.
Brian, as we look forward into 2022, we're looking at something we haven't seen in a good long time, and that is the tightening of monetary policy rather than the loosening of monetary policy. Give us a sense of what you're looking at, and just to be specific, as you make projections at Bank of America, how many rate hikes do you expect out of the Fed in 2022?
Well, there are two parts to that. One are our research team led by Candace Browning-Platt, and the team is terrific, and they have 4 rate hikes in next year. But internally, we model our future income off the curve. We don't fool ourselves and let anybody make a projection. But look, inflation is here. The economy, is going to grow at 6.42. So think 6 in 21, 4 in 22, and 2. Get to the 2% growth rate in 23. And think of it this year as making that adjustment. That is based on the tightening, first the fiscal stimulus stopped last year, and now the monetary stimulus is being pulled out because the economy is as big as it was, growing faster, unemployment's below 4. The conditions are right to go ahead and actually reduce the accommodation, with one big caveat. Does this virus go in some direction that cause some damage that people don't understand? And the good news is, we're winning the war on the virus, the vaccines, and everything you know about. But remember, the key is that 6.42. The economy is slowing down, and part of that is the engineering that goes on to bring it into a more of a sustainable growth rate, because it was growing faster than it usually grows. And so, will rates go up? Yes. 4 times this year is a prediction. The reality is, does that help our earnings? Yes. But the real reality is that's to bring the economy, to take the inflation out of the system, and if they get it right, because the economy is growing very fast and inflation is growing very fast. As that slows down, we should get back to normal economy. And think about our economy being bigger than it was in 19 already on nominal terms, and predicted to grow at twice the rate. Of course, we have to worry about inflation, and that's why they have to raise rates.
What is your level of concern about a possible policy error? A lot of people are talking about that because the inflation numbers are rather alarming, including to Jay Powell, the chair of the Fed. And the question is, how much does the Fed have to intervene as opposed to how much they can take advantage of some of the things you're talking about, which is the economy slowing down on its own?
Well, I think the question is if we were sort of finally normalizing rate policy into 17, 18, 19, and that then they were able to do that, and the economy kept being predicted to grow at 2% or so, which meant that it was working, right? And now the problem is now they have to go through it again. Could they overshoot? The answer is absolutely possible. Do they want to overshoot? I guess the answer would be absolutely they don't want to. But the reality is this is trickier because the velocity of the change here, much different than we've seen. The velocity down and the velocity back up has been unbelievable. 30% down in a quarter, 30% back up, or 20 whatever percent, and then moving. And so that's the question. So could you overshoot it? Yeah, because this is a completely different set of circumstances going on. Underneath what's going on, too, think about inflation, the inflation aspects of wages you talked about earlier, but also think about housing increase in prices, think about goods increases, think about supply chain shortage. So it's a much trickier case than before. So I think the market expects them to raise it. The market expects them to keep that inflation above their target rate if they can, because frankly, it's taken a decade to get it back there. And so all that's kind of expected market. The mistake, the market will be worried about is worried about a mistake because it's tricky execution. Now, the key, David, is what's going on that we see. And our consumer spending, in the fourth quarter was much stronger than the third quarter, the second quarter, the first quarter, either over 19 or 20. You can pick your year last year. It grew at 30% over in December of 21 versus 19. Think about that dimension. Coming into January, it's still growing at double digits. So consumers are out spending money, and that's good for the economy, but also that means that you have to be careful that people aren't getting, it's just getting too fast growth and has to be managed, and that's what the Fed's trying to do.
Finally, Brian, what does the likely path of the Fed mean for Bank of America in terms of loan growth? I know you'll make more money if the yield curve steepens, but what about loan growth?
Well, we make more money at yield curve steepens because the nominal rate environment goes up and we have $2 trillion of deposits, and that are huge core deposits and they hit zero floors when rates come down. That's sort of $6.5 billion, 75% short curve on the short end of the curve driven by the deposits. On the loan growth, it's really going to come down to economic growth. So what I would expect as the economy normalizes, you're going to see companies borrow back up to the line levels they had in 19, which is 35%, and that'll drive another chunk of loan growth for us. And then if our teammates are as good in the market as I think they are, they'll get more customers and get more from them. But basically we always have thought that our loan growth should be slightly better than the economy, but largely as the economy goes from a 6 to 4 to 2 growth rate, you're going to see loan growth more normalized, and we should grow at mid-single digits or better, which we had been doing before the pandemic, and growing a little bit and growing market share, but also just growing on a core basis.
Okay, Brian, really appreciate your time today. That's Brian Moynihan. He's the chair and CEO of Bank of America. Now back to you.
David Weston, thank you very much indeed. Fascinating conversation, lots to digest and think about coming out of that conversation. Alex, he talked a lot about the business. He talked a lot about the macro story as well. My sense was that Brian was thinking a lot about the rate of change here. Things went down very fast. They've come up very fast. The Fed is going to have to manage that. Rates are going to go higher. But this is a really difficult environment at the moment just because of the pace at which things are moving.
And the same thing really goes for comp. That's what I found most interesting as well. Obviously, compensation, the biggest expense for B of A, but would rather pay more people and grow the business. And that's sort of, I think, the theme is what we've heard from many bank CEOs. I guess the question becomes just how much more do you have to pay and how sustainable is that? Or how much faster does your business have to grow to offset that?
Absolutely, and this is going to be one of the real challenges. We've had to deal with the supply side shortages within the economy driving inflation. Does that now start to come into the wage inflation story? We've already heard from the banks that the answer to that question is yes, as you say. We don't know yet how sustainable it's going to be. I wait now for the rest of the earnings season. What are other CEOs going to be saying in the service sector, the industrials, etc., in terms of managing this story? And is that ultimately going to end up hitting margins? We're going to talk more about this next. Where does the economy grow? President Biden marking his 1 year in office today. Interesting press conference yesterday. We'll talk about it next.